talking today about quitting our jobs or about retiring, probably more specifically. I'm going to tell you up front, as I was putting this together, this is one of the things that I'm probably most excited to talk with people about. This is the whole goal of the retirement plans that we have, is to help people figure out the best way for them to move into retirement. But it's a difficult thing to do for a group of people, right? Because each person is going to be bringing in their own unique situations and circumstances. So I'm going to encourage you as we go through this. A lot of this is going to be kind of high level stuff that you should be considering. We're going to break it down and talk about kind of setting the stage. So the first couple minutes of this are going to be talking through the things that we should be doing probably 5 years out, 10 years out from retirement. Then we're going to get into creating a plan, which is the things that we're going to be doing with about 18 months to go before we push the button on retirement. And then we're going to be talking about the actual first part of retirement. We're transitioning into that retirement phase. So that's our plan for today. But as we go through this, if you have questions or you're trying to think through, I know my situation's a little bit different than other people's situations, please feel free to reach out to me. My contact information is always available to you. I'll pop it in the chat as well so that you have that. Reach out, spend some time. We can spend some time talking about your situation. We can help game plan that a little bit. Hopefully this is a useful time for you this afternoon to be talking through how to get everyone retired in 30 to 45 minutes. I'm gonna tell you, we got a lot of information to go through. So let's jump right in. So as I said, we want to start by kind of setting the stage. What should we be thinking about 5 to 10 years out from retirement? So we hit 55, we start thinking, yeah, I don't want to do this forever. I'm ready to push the button. I want to retire. What should we be looking at? Well, we should definitely be doing that kind of mid-career review. We need to check our savings. Where are we at? Are we on track or not? Have we done any calculations to identify if you're saving enough? We'll talk about this in a little bit more detail here in a minute. But I get asked a lot about the investment allocation that's appropriate for a person. And what I generally tell people is the first thing you want to start with is making sure you're saving enough. Saving enough is going to be so much more important over the long term than making sure that you're invested appropriately, right? We want to make sure that those things work together. We also want to make sure we're maximizing those contributions. When they are available to us, let's make sure that we're utilizing them. In terms of Social Security, you're going to want a little bit of time. One of the things that I found is with government agency, and Social Security is no different. You want more time rather than less to look over and see what your options are, what options would be if you pull Social Security early, if you pull it a little bit later, and game plan to figure out how that's going to fit into your strategy as you get closer to retirement. That's something to start getting your estimates on, probably 5 to 10 years out. You can get those on ssa.gov. If that's never something that you've done before, I'd encourage you to step out there and do that. The other thing that you're going to want to game plan for very specifically and start thinking through this a good bit in advance is healthcare. Yep, you can jump onto Medicare when you're 65, but Medicare doesn't cover everything. We'll talk a little bit more details about that in the transitioning part of our conversation today. Medicare doesn't cover everything. So for example, it doesn't cover dental. I don't have great teeth, so I know that I better be planning for dental insurance, covering that on my own as I get into retirement. The other things that people will want to make sure you're thinking through are things like prescriptions. You might want to be game planning around just looking at your family's overall health and dynamics. Maybe you need to be starting to think about, do I need long-term care? Would that make sense for me? Do I have another investment vehicle that I want to set aside for those kinds of goals? We want to make sure that when we're getting into this part of this early part of financial planning around getting ready to retire, that we're thinking through all the different variables while we still have time to pull levers. So the other thing that we want to do in that period of time, probably 5 to 10 years out from retirement, is actively working on reducing the debt that we have. In an ideal world, right, we would want to go into retirement where we're going to be on a fixed income or a more fixed income with as little debt as possible. Sometimes it's not always possible to, pay off the mortgage. That's okay. We just want to make sure that we're game planning what kind of debt we're going to have, what that's going to look like, and that we have our arms really well around that. Then we'll start getting into our actual estate planning and transitioning. This will get a little bit, we'll dial into this a little bit more in that first period as we transition into retirement. But generally speaking, in that 5 to 10 year period, this mid-career review where we start looking at, am I saving enough? Can I maximize contributions anymore? Do I understand what Social Security is going to look like for me? Am I thinking through my healthcare needs? And have I reduced debt? If I can focus on those 5 things in the 5 to 10 years prior to pulling the trigger on retirement, I'm going to be in better shape for the period of time that we get about 18 months before we retire. Now that leads me to a good point, right? One of the first things I said is, well, am I on track? What am I going to need? It's very difficult, I think, for people to really be able to picture this. So I like to give people a retirement savings goal that when we're thinking through this with several years to go before retirement, it kind of gives us an idea or a relatively predictable idea of how much income we're going to need versus how much savings we'll have. The replacement ratio is something that we use a lot to do this, to have this conversation. So a replacement ratio is just a percent of our income that we're going to be able to replace from retirement income sources in retirement. Generally speaking, we're going to tell people you want to shoot for a replacement ratio of 75 to 80% of your current income. So for those of us who are who are not great at math and we're looking for kind of an easy number there, if I made $1,000 a month, I need to replace $750 to $800 a month. That's what we're talking about with that replacement ratio. We want to also consider the power of inflation in that calculation. One of the things that we look at here, this is showing us projected inflation of some different items, today's cost in 2026. Well, we think that the cost of that might look like in 2056. You can see there's some pretty huge increases on that. The cost for coffee, a gallon of milk, most of these things we expect to pretty close to double in expenses over the next 30 years. So if that's something that we're considering, we might want to be a little bit higher than that 80% replacement ratio. For most people, though, I would tell you we probably don't need to be at 100% replacement ratios. The reason why, if you think about it, let's say I'm saving 10% of my income right now for retirement. Well, then I'm not living on 100% of my income today. I'm only living on 90. Other expenses tend to come down as we get into retirement as well. We don't tend to spend as much on going out to eat. We're not eating lunch maybe as much as we were when we were working. Our gas expenditures can tend to go down. When we think about, though, what our replacement ratio, kind of safe replacement ratio looks like, a lot of that's going to be dependent on the lifestyle that you lead. When we say 75 to 80% is a kind of safe replacement ratio, we're thinking about the kind of person who probably has a good deal of their debts paid down. And so maybe a little bit of debt going into retirement, but probably not something like their mortgage. A person who's got in that 70 to 80% replacement ratio, we're generally thinking about that person is going to be trying to live a pretty similar lifestyle to the one that they're living now. So as an example of that, I'm going to pick on myself here. I have always wanted to travel to Europe. I've never really been able to travel. I've got kids, they can pay their own way when the kids there. When I do that, and when I retire, that's when I really want to go do some of that travel. So am I going to be at 80% replacement ratio? Probably not. I'm probably going to be higher, at least for the first few years. So when I'm thinking about my replacement ratio, I'm probably going to be thinking above 80%, probably something closer to 85 or 90%. But if you're like, I've got most of my debt paid down, I'm going to have my house paid off before I get to retirement, and I really don't have any big travel plans, you might be closer to 70 or even 75% replacement ratio. Hopefully that gives you an idea when we talk about these. So kind of rule of thumb, if you've kind of no idea where to start, when I talk about am I saving on enough? Am I on track? That 75 to 80% is kind of a general guideline, plus or minus based on your expectations for yourself in retirement. Obviously, the more we save, the sooner we save, the easier it's going to be for us to hit that. I tell you, one of the things that is, when we think about the kinds of retirement income sources we're looking at, most people are going to be pulling their retirement income sources out of one of these kinds of buckets. You're going to have qualified investment sources like 401ks or a 403b or an individual retirement account, an IRA. You probably will have some after-tax assets too. So generally we think, I mean, you could have an IRA that's investing in high yield savings or CDs, but for the most part, high yield savings and CDs tend to be after-tax money. So that has a different tax implication to us when we draw that money out than it does when we pull our money out of a qualified source. We'll talk a little bit more once we get into that kind of 18-month range about how we game plan what we're going to pull and when we're going to pull some of those sources. The other ones that you might want to look to see what kind of income you might have are common income sources that we see when people get to retirement, annuities or pensions. Very commonly we'll see people who maybe they have a small annuity or a small pension. Maybe they worked for the state. They've got a small employer plan through the state there. So real estate investments are one that we see pretty commonly as well. So I mentioned earlier, we were going to talk a little bit about the role of investing in kind of our overall game plan, that 10 to 15 years or 5 to 10 years out from retirement. So often people will talk to me about, well, what investment allocation should I have so that I can really maximize this? And I'm going to always go back to, are we saving enough? Because you want to make sure that your investment allocation is something that you feel comfortable with the overall amount of risk. And sometimes that means that you might not have quite the ability for returns that you project that you're going to have. One of the rules that we can use to see, okay, based on what I'm doing, based on the kind of investments that I have, what could my account look like over a period of time? We'll use this rule of 72 that you may have heard of, which talks about how long it's going to take for my investments to double based on the current expected annual rate of return of that investment. So if I divide 72 by my annualized rate of return, that's going to give me approximately the number of years that it's expected for my investment to double. So if I'm a pretty conservative investor, and let's say I've got a portfolio that's got an expected return of maybe 4%, it's probably going to take about 18 years for that investment to double. That's important to know when we're game planning retirement. Very rarely do I run into people who are within 5 to 10 years of retirement that are willing to take on just a ton of investment risk. There's only so much our investments can do for us. We want to make sure that we're saving enough. That's going to be way, way, way more important than just relying on an investment return alone. But this might help give you an idea of how long it will take for your retirement savings to double based on the kind of return that you want. If you have questions about your asset allocation, you want to talk about your situation, absolutely give me a call, shoot me an email. We can talk about your investment allocation, how much risk you might feel comfortable taking, and then how we factor that in to the potential growth of your assets over time. So as we get closer to retirement, one of the things that we're thinking through is, again, it's going to be so important to understand, making sure that we've got the things there that we need. That proper savings really allows us to make sure that we're going to be able to live as comfortably as we need to, that we've accounted for cost of living increases, healthcare, food, insurance, inflation, like we talked about earlier. We want to make sure that we're thinking through what our risk tolerance is, as we just discussed on the last slide, to make sure that we get a return that we feel comfortable with for the risk that we feel comfortable with. We want to talk through our time horizon. How much time do we have before we're going to be retiring? Is it 5 years, 7 years, 8 years? Those have different implications in terms of how much risk you might feel comfortable taking. Once you've got that investment plan in place, you're going to want to make sure that you just follow the investment plan. Stay diversified, make sure you're rebalancing, make sure that asset allocation is appropriate for you. If you have questions, again, ask for help. I think sometimes people are afraid to ask, and that's what we're here to do, is to make sure as comfortable as you possibly can with a retirement plan that you are creating for yourself. All right, so we have kind of come full circle here. We've talked about the savings and investments. We've talked about our income streams, the different kinds of income that we could be looking at. We've talked a little bit about healthcare planning, making sure that we're thinking through what kinds of needs are we going to have as we get closer to retirement. One of the important things that you're going to want to get as we kind of begin to make this transition from 5 to 10 years out to 18 months out is budgeting. It is really important to go into those retirement planning conversations with a financial planner with a good budget in hand. It's difficult to be able to figure out exactly what we're going to need to pull from what in the most efficient ways if we're not sure. So using that 75 to 80% replacement ratio is a great place to start. But as we begin to transition now from 5 to 10 years out to retirement to more like 18 months, we're going to need to sharpen the pencil and get really detailed on that budget. We're also going to want to make sure we start thinking through that estate planning more, and then emergency funds. So as we get into retirement, one of the things that I will always encourage people to have at that 18-month point, I would really like the person who is entering into retirement to have about 12 to 18 months worth of income available for them in an emergency fund. Why 12 to 18 months? Well, I'll tell you, because if we do see a market correction, generally speaking, market corrections have been in that 12 to 18 month range from the time that they've bottomed to begin to see recovery. So if you're a person who's getting ready to retire, the last thing that you want to have happen is for the bottom to fall out of the tub and for you to be like, well, I had all of my money in these more aggressive investment options. Now I'm going to have to postpone my retirement for a year so that my portfolio can recover. That's why I encourage people to try to look to have about 12 to 18 months in something like a emergency fund cash type option so that we don't have to delay your retirement if that happens. There's options for us to look through. And also because we know that as you get into retirement, you'll still have emergencies, right? Cars will still break down, things will still happen. And now you don't have the income that you had before that you might be using to cover that. So I generally will tell people that an emergency fund in retirement is going to be different than your emergency fund in your working years. In our working years, we usually tell people your emergency fund should be between 3 to 6 months of your income because most of us have some form of like short-term disability or long-term disability that would kick in after that elimination period, which is between 3 and 6 months. We don't have that as we get to retirement, right? There is no disability for us as we get into retirement. That's why we'll tell people usually you want that to be a little bit bigger. I would encourage people at least about 12 months. Before we transition into the next phase of retirement, what questions do you have for me? Any questions? Great. Well, then let's talk about creating our plan. We're going to get specific. I think this is probably the most difficult part for people when we first retirement is really getting into the details about what your situation looks like. As we discussed, it's going to be different from person to person. The more details you can bring into a financial planning situation to help with your retirement picture, the better it will be. Getting a really solid budget is a big part of that. I think I hit that pretty hard already, but you'll not believe how many times I sit down with people who are getting ready to retire in the next year. And I'm like, okay, well, what's our budget? And they'll say, well, I'm not really sure. So that's one of those things that it gets a lot harder to nail down how we're going to create enough income for you, until we kind of know what we need and what sources we have. So make sure that you have a good, sharp retirement budget. We want to plan for inflation. We'll help you do that. Usually what we expect is, right, if I look at my current budget, what that looks like, what we would generally build in for inflation would be about 2.5% per year. That's a kind of average inflation that we would expect for the cost of goods and services. There's going to be situations where inflation will be higher and lower than that, but that's generally what we will plan, how we will plan that. You're going to want to evaluate your estate planning needs. So this means we're going to look through and see. So at this point, we're about 18 months from retirement. I want you to know, do I have a will? Do I have a power of attorney? Do I have a trust? Do I have advanced directives? Those don't necessarily need to be complete, but you're going to want to know what you have and what you don't have. What holes do you need to fill there? You're going to want to pull together all of your financial statements, include all of your assets, checking, savings, CDs, brokerage accounts, retirement plan, IRAs, mortgage statements, if you're still paying those, any applicable pensions or annuities. Pull it all together so that you can see what income sources you have versus what kinds of expenditures you're still going to have. Don't forget to take a look at your life policies. So there's 3 kinds of life policies that we'll see. Whole or universal have cash values. Sometimes are used for retirement planning. Term policies don't have cash values, but they can still be an important part of your retirement planning as you get closer to know, okay, well, when does that term policy expire? Do I need another one? Maybe I do, maybe I don't. So having an understanding of what your policies are will help in that financial planning situation. Long-term care policies, again, if you have those in place, or that might be something that you need to consider, we can talk through what those look like for you. But if you have those policies, make sure you bring them along. Those long-term care policies, I'll also point out disability policies, because sometimes those disability policies have riders in them that allow for a transition from one kind of policy type to another. I'll say life insurance policies can be really confusing. So sometimes even just having those pulled together so somebody can go through and help you look through what you have, what options you have, and if those make sense for you to maintain in retirement or not, can be really beneficial. The next thing, this is going to get into that healthcare conversation. Track your prescriptions, health history, document any needs and concerns that you have. Tracking prescriptions is really important, especially as you get into looking at Medicare, because you're going to find that there are certain things that you might need to get additional or supplemental coverage for. You want to make sure that you're not going to get taken by surprise by that. So knowing what you have for prescriptions and how that would be covered is going to be beneficial. Again, things like that health history, like I was picking on myself earlier. I know I'm going to want to have dental insurance. That's going to be important for me. But maybe there's other things for you that you're thinking, like you've had maybe a history of heart problems, or maybe you've had cancer. Those would be things to make sure that you're thinking through, you're documenting those, because you might want supplemental policies on top of Medicare to help cover any of those gaps. There are big gaps in Medicare. It does not cover everything. Making sure that you have the right things in place to cover that is important. So game planning that ahead of time will help you. Getting your Social Security estimates, again, I mentioned this, SSA.gov. You're going to want to really make sure by about 18 months out that you have a really good handle on what your Social Security income will look like. Once you have everything pulled together, now it's going to be pretty clear for you to see what gaps you have, right? What things am I missing? What things should I have that I don't have? Sitting down with the financial planner as you get all of this stuff together, they'll be able to help you analyze, hey, do you have this? Maybe you should see if you've got something extra here, and help you see what policy things you might want to address. All right, so once we've got all of that together, all of that's been laid out, now we're going to start looking at the kinds of income that we have coming in. So this is why we want to pull in all of our financial statements, everything, because what you're going to be able to see once you have your budget and your income sources together, you're going to be able to see what sources are fixed income and what sources are flexible income. So fixed income is going to be things like Social Security, pension, same amounts coming in every single month. I don't really need to do anything around that. Flexible income sources are generally things like IRAs, 401ks, 403bs, those kinds of investments, because what we're looking at here, if we just pull that money out, we might have a situation where you're withdrawing more than the investment is returning, in which I draw that down too quickly. So you might amount that you'll be pulling from the kinds of sources. So understanding what's fixed and understanding what's, and then looking and seeing what your budget looks like. So what's in my budget is fixed versus what in my budget is flexible. So making sure that I address those to be able to see what gaps I have. What we'll see is that we'll have a person who comes in and they'll have created their budget for themselves and their fixed income sources, and their fixed income sources are going to cover their fixed budget sources. So they feel pretty comfortable. They're good. A lot of times, though, what I tend to see is that our fixed budget things, the items that are in our budget that are fixed costs, those are not going to be fully covered by our fixed income sources. So then we have to look at what options are available for us from those flexible sources. Do we want to take some of the money out of an IRA or 401k? Do we want to annuitize some of that? Do we want to draw a flexible income from that? Being able to identify what kinds of sources we have is going to make a huge difference to help us set up the best outcome for you in retirement. The other thing that you're going to want to do is we pull these things together is once we know what we have for financial assets, we can also begin to identify what tax considerations apply to those, right? We want to know how we're going to be taxed on the withdrawals and incomes. That is going to be really important. For those of us who live in the state of Iowa, we are not taxed on our state tax. We don't receive state tax. On our retirement income, but on other sources of income, you sure are. So making sure that you understand what your taxation sources are going to look like, what the federal taxation and what the state taxation will look like on those sources will be important. In general, so some of the things that I see very often for people in retirement, I see 1099 income quite a lot from people. So that would be like, I retire from my company, but I'm doing some consulting work for them. Then I'm going to get some 1099 income. That 1099 INC, that is going to be taxed as ordinary income. I might also get a K1 distribution. So maybe I've got some stock or I'm part of a trust. I see this a lot too, where people will have like maybe a family farm and there's income that's coming off of that family farm. That's going to be part of a K1. That's going to be taxed as ordinary income. Schedule E or rental income. Maybe I've got a condo and I am renting out that condo. It's part of my income in retirement. Those will also be taxed as ordinary income. You also may have taxable accounts, things like brokerage accounts. Those are things, they're going to be either taxed as short-term or long-term gains. Long-term gains are going to be more advantageous. So a long-term gain, I'm looking at about 12 to 15% taxation, where on short-term gains, I could be looking at 37% taxation. So knowing if you have taxable accounts, if they're short-term gains or long-term gains, will help you understand what kind of taxation you're looking at there. Then you have your qualified tax deferred accounts, right? 401ks, IRAs, all of those things, they're generally going to be taxed as ordinary income when they were received, but they will not be subject in some cases, depending on the state you live in, they will not be counted as income for the state taxes. They will be counted as federal, but may not as state, depending on the state you're in. Another thing, the tax exempt accounts, maybe you have Roth accounts or Roth IRA or Roth from your 401k plan. Those Roth accounts, if we pull those assets out, as long as we're over age 59 and a half and we've had the accounts for at least 5 years, we don't pay taxes on the distributions from those accounts. Sometimes we'll use those as kind of tax of pools of assets that we're going to wait to pull from until later into retirement because we want them to enjoy as much of that tax advantage as possible. Last thing I'll point out here, Social Security is in fact taxed. We'll talk about that. That is probably one of the biggest myths that I hear from people is, oh, Social Security is not taxed. Well, it is subject to tax. So we'll talk about how that applies to us. The thing that I'll tell you, estimate your tax bracket. If you have an accountant, great idea to talk with your accountant about your projected income, the sources of income that you have, any deductions available. There is a new deduction available from the One Big Beautiful Bill Act for seniors that may apply to you. It is based on your income, so some people will get it, some people won't. But understanding what your deductions are may help you better plan what sources to pull from. There's also online tools, resources available to help you project your taxes and learn about deductions. This 2025 federal income tax bracket is a great one to utilize. There's all kinds of little tips and tricks in there. All right, so I hit that kind of high level of like all the different sources and how they might be taxed. But when we think about how we're going to take withdrawals from those, this is just hypothetical example. Traditionally, what people will generally tell you is, hey, well, we're going to draw this first from our taxable accounts, second from our tax deferred accounts, and then last from our tax exempt accounts. So to give you an example, let's say I have a brokerage account that's worth $200,000. And then I have my IRA that's at $250,000, and then I have a Roth IRA at $50,000. In this traditional example, what people will tend to do is have you break that down and say, okay, I'm going to take first from the taxable account, then I'll move to the tax deferred, and then I'll move to the Roth account. By doing that, our estimated taxes in this example is about $56,000. It may be a better solution for you to pull those in a proportional manner. So rather than drawing down each of those, you pull a little from each of those tax accounts. And by doing that, the proportional amount, we may be able to pay less in taxes by doing that. You're not going to know, though, unless you've sat down and identified what sources of income you have to break down how that income is going to come to you. And then you can begin to estimate taxes. So if this is something that you have available, bring it to your financial planner. They'll help you work through this. Again, if this is something you want to talk through and you don't have a financial planner, that's what we're here for. Give me a shout, shoot me an email. I'm happy to help you walk through it. Generally speaking, when we talk about withdrawals from our retirement accounts, we're going to have tax qualified defer. We have required minimum distributions, which start from tax deferred accounts like our 401k plans at age 73. At age 73, we don't have to take the full amount out, but the IRS will tell us that we have to take a specific amount out. It's based on our mortality table. If we don't take that out, we'll be subject to ordinary taxes plus a 25% penalty tax. So it's really important that you take those out. When we talk about our withdrawal rates from qualified accounts, if we're thinking about what a safe withdrawal rate is, for the most part, what people will say is between 4 and 5% is a safe withdrawal rate. I have absolutely heard people say less. I have absolutely heard people say more. It will depend a little bit on the kind of investments that you have and what you have as an investment, balance, what your income sources look like, what your other income sources look like. So for example, if we go back to the situation where my fixed costs are covered pretty well by the fixed amount of income that I have, I can take a little bit more risk on my qualified accounts, and my withdrawal rate might be a little bit higher, might be a little bit lower, and I'd be okay. But I might be in a situation where I'm going to be a little bit tighter, and my withdrawal rate might have to be a little bit less just to make sure that there'll be enough for me as I get into retirement. So when we talk about that safe withdrawal rate, know that there is variance there depending on the situation that you're in. The withdrawal strategies, as you probably gathered, they're complicated. So if you have questions, again, reach out. This is what we're here for. We want to help you make a plan that you feel comfortable with. These are the kinds of things that we want to be considering with about 18 months to go. We really want to start getting granular in what do we have? What kind of income sources do we have? What kind of budget are we working with? So we can create a plan that works. Now, let's talk about what we're going to do once we get into retirement. So transitioning into retirement, this is our last section. There's a lot here on this first slide, but I'm going to really hit the high levels. When you hit retirement age, that is the time for you to be making sure that you are going through your estate plan. As I mentioned earlier, with about 18 months to go, we're listing out what do we have, what do we not have. This is the time to know, do I have a will? Is it in place? Is it how I want it to be? Do I need a trust? Do I have power of attorney, healthcare power of attorneys? We want to make sure that we have these in place as we get to retirement. One of the things that's, I think, probably every person on this call has experienced, somebody who enters into retirement and they pass away pretty suddenly and they don't have any of this stuff. It makes it very difficult for people who are then trying to help move that account over to their beneficiaries and survivors. So having those things there is really important. There's wealth transfer as well. So if you're a person who, you're looking to see, I'm not going to need all the money in here. We've gone through and done the planning, and I want to make sure that I give some to my kids or grandkids. There are rules about gifting that you'll want to look through and make sure you're sitting through to figure out how do you form the right wealth transfer plan for you. Get situation you're in, a shout. Happy to help. If you need a good attorney or recommendation there's absolutely something that we can recommend to you. Another thing you're going to do, Social Security and pensions. So one of the things that I talk about here a little bit is at a high level, I think we're all aware. The earlier we begin to draw Social Security, we're going to have a reduction in benefit for that, right? The reduction, if I take that benefit at 62, I'm going to get 70% of my expected Social Security at my full retirement age. If I go at 63, it'll be 75% and so on. Once we get to right now, our full retirement age is 67. You get 100%. Each year you wait, you get an additional 8%. After age 70, you don't get any additional benefit, right? 70 is our maximum age for our Social Security filing. In terms of should I take my benefit earlier or later, if I think I want to take the benefit earlier, what I'm looking at is generally, do I think I'm going to need that money right now to help me pay living expenses? It's going to be my fixed income source. Maybe I can't work anymore, and I know that my ability to earn is going to be a little bit limited. Then I might want to draw early. If I have caregiving responsibilities, maybe I lost my job. Those might be reasons that we start to pull early. If we're thinking about maybe waiting to pull, it's usually things like, I don't need their money right now, and that additional amount might be pretty beneficial for me. Maybe you have other income sources, you're pretty well set. Or you think you're going to have a higher life expectancy. So maybe you think, looking at your family history, you might live to be into your 90s. If that's the case, you might want to wait a little bit longer to get that bump. It used to be when I would talk to people that I would tell people, hey, wait as long as you can. I am no longer in that camp. I am fully in the camp of understand what the trade-offs are for you. Very often I've seen it be the difference between taking it at 65 or 66 and 67 is like 150 bucks a month. If that's going to be you and 150 bucks a month isn't going to bother you, then I'm going to tell you to take it, right? It's going to be dependent on kind of where you sit in what your estimates look like, and then kind of what your income level looks like, what your needs are, whether or not it makes sense for you to draw early or late. Absolutely something to chat about. If you've got those estimates, we can work through it. The thing that I want you to know is that if you do take it early, Social Security is subject to federal tax. There's two things you need to know about this. First of all, if I take that money early, it is going to be reduced. Social Security is going to be reduced if I take my money prior to my full retirement age. If let's say I take that when I'm 65, and let's say then I'm earning income, right? I'm doing that consulting work. I'm getting 1099 income from someone. Or I decide, I'm going to go work at the Home Depot and build grills. That's something that I'm doing. I need to be very aware that if I earn over $24,480, it's indexed every year. If I earn over that, they're going to reduce my Social Security benefit for every $2 I earn over that limit. So if I earned $3,000 over that limit, they're going to reduce my benefit by that amount. So a $1,500 benefit reduction. If I do it in the year that I reach my full retirement age, I have a higher limit. Now it's $65,160, and they'll reduce it for $1 for every $3 I earn over that limit. After my full retirement age, though, there's no limit on earnings. So if I'm 68 and I decide I want to go grills at Home Depot, I can earn as much money as I want, and they're not going to reduce my benefit. But it is something to be aware of. So anything that's going to count as earned income, wages, tips, bonuses, commissions. So that commissions one really gets people who are retiring. Maybe they were in a sales position and they're retiring at 65, and they draw Social Security and they get this great big bonus after they leave. That absolutely hits people. So just be aware of how that will work, and make sure that you're thinking through that timing. Depending on your income, up to 85% of your Social Security benefit is subject to federal taxation. So if my household, so I put this in here, single and married, I'm just going to hit the married one. If I'm married filing jointly and my income is less than $32,000 total from all sources, including Social Security, I won't pay tax. But if it's over 32,000, which for a lot of people it is, then part of my Social Security is going to be subject to federal taxation. It may not be taxed at the state level, again, depending on the state that you're in. Okay, just a quick note on our healthcare and long-term planning. I'm looking at the clock and I told you it was going to be tough for me to get through the 30 to 40 minutes. Medicare, health savings accounts, long-term care insurance. When we think about Medicare, one of the things that I'll point out to you is if you're a person who uses healthcare, the health savings accounts or those HSAs, you'll want to make sure that probably a year prior to you switching over to Medicare, you switch to a more traditional program. That can delay your ability to qualify for Medicare. So be aware of that going into that situation. If you're though thinking you're going to retire prior to 65, and you're you have to cover your own healthcare insurance, maybe you're going to retire at 60 and you've got 5 years to cover, you could use an HSA to cover premiums on healthcare insurance. So sometimes people will use this as kind of a way to bridge if I'm going to try to retire a little bit early. We talked a little bit about long-term care insurance. I'll tell you, long-term care insurance is one of those things that gets really expensive to buy for yourself if you're over 65. When you're younger, long-term care insurance tends to be cheaper. It does go up over time. Sometimes another way that people will use long-term care is kind of to essentially self-funding it, right? They'll set aside a pool of assets that they're going to have available, either a tax advantage like a Roth that I can pull out without taxation down the road, or an after-tax account like a brokerage account, CD, something like that, where they're going to leave it out there invested for the purposes of if I have to go to long-term care insurance, I'm going to use that pool of assets to help cover my long-term care costs. And if I don't need it, then that gives me a pool of assets to pass on to my kids or grandkids. Ooh, I hit a lot. I'm fully going to recognize that I hit a lot here. There are all kinds of tools and resources that are out here for you. I know that it is almost impossible to go through all the different concerns that people have. There is Am I on track? If you want to know if you're saving enough for retirement, we have a link here that's available for you. Um, if you want to see how long your money will last, again, there's some links that are available for you, helping you identify if your Social Security would be taxed, what that's going to look like. There's calculators and tools that are all available for you out on our education site. This will be information that will be passed along as kind of a follow-ups to this message you'll find in our next upcoming education. So if you want to utilize those resources, or you can give me a call, shoot me an email, you'll see my contact information here. I'm more than happy to go through your specific situation, help you identify, are you on track? What kind of income sources do you have? Help you begin to think through the order in which you take those and how that might impact your overall taxation. Like I said, there's a lot to get into when you start breaking down all the different pieces in retirement. I hope that what you come away with more than anything is knowing while there's a lot out there, you have people to talk to. Please feel free to give us a call. We're more than happy to help you walk through your situation.